But we haven't had this set of circumstances in past yield curve inversion occurrences. So, I mean, inflation rate way higher. The amount of money added to this, into circulation over the past couple of years, way higher. The debt, way higher. So it feels like, the Fed is just out of bullets at this point to combat. I mean, are they just? Is it realistic for them to just buy up a bunch of treasuries, to help manage the yield curve? Can they even do that? Will they do that? And if they don't, what happens?
That's the toxic sludge that's being poured into the stream, right? At the root cause of what's happening. I think some of them are starting to wake up to that idea and realize that. And so they're hesitant to step in and do any type of further manipulation as far as yield curve control or UBI or anything, because they know that when you go back to the root cause of why are we seeing all price signals breaking down? Why are we seeing these inflationary prints, which were very high before Russia and Ukraine even happened? What I think you're going to have happen here in about 6 months to 9 months from now, people are going to forget that those high inflation prints happened for nearly an entire year before that even happened, right? The market is very short-sighted. The narratives that run collectively amongst the population are extremely short-sighted, but don't ever forget that point. So I think central bankers understand that. As soon as they step in and they start doing yield curve control, that's QE squared. It's going to just further add more units into the system, and they've got to guard against using that as long as possible without creating massive volatility and disruption and dislocation in the market, which could be right around the corner. I mean, you could see that in the coming quarter, as far as I'm concerned, based on the negative spreads, the magnitude of these negative spreads that we've got right now.
Andy,
yeah, I agree. I mean,
changing world order level stuff.
Yeah, I mean, Preston, to your credit, you've been talking about yield curve control and looking forward for it, probably I think for a period of years now. And I think it's right. I mean, it's the ultimate end game. You had a phenomenal conversation with Luke Groman, I think, recently on your pod, talking about who's going to buy all these treasuries. Well, maybe not Russia and China, on account of if you buy it, surprised you don't own it if it's in the dollar system, right? So somebody's got to buy this stuff. I mean, it's already been years in which several of these foreign countries have been reducing their treasury holdings. I mean, they've been planning ahead. They've been cutting their treasuries and buying gold. Who knows? Maybe some of them have been buying Bitcoin too. I doubt they would disclose it if they were, at least not yet. And so, yeah, it's kind of the logical conclusion. Someone has to buy this paper. And so that someone is likely to be the Fed. And that's none of us can say whether that's going to be 3 months, 6 months, a year, 2 years from now. But the logic is pretty strong. I mean, the gravitational pull toward that outcome is so strong that it just seems highly improbable to me that we don't end up with that situation eventually. And just for people who aren't aware of what yield curve control means, it means instead of the Fed saying, oh, we're doing QE and we're buying whatever, $100 billion of bonds per month, instead they say we will buy as many bonds as you want to sell us in order to pin the interest rate at some particular level. And they've been doing that in Japan for a very long time now. And yeah, I would be surprised if we don't end up there in the U.S.